Good afternoon, everybody, and welcome to the ClearBridge Aggressive Growth, Multi-Cap Growth Third Quarter 21 update, targeting a broader opportunity set. My name's Bailey Davis, and I'm a Managing Director and part of the Portfolio Specialist team here at ClearBridge. I'm very excited to be joined today by my colleagues Evan Bauman and Aram Green, co-portfolio managers of the ClearBridge Multi-Cap Growth and Aggressive Growth strategies. Combined, Evan and Aram have over 45 years of direct experience in portfolio management. Today, we're going to give an update on the strategies along with some talking points on positioning and what to expect with the portfolios going forward. So why don't we get right into it? Evan, you've been a part of the strategy for the last 20 plus years. With last year's announcement that Richie Freeman would be retiring as a portfolio manager at the end of this year, can you give us a walkthrough on some of the changes you and Aram have implemented so far?
Yeah, sure. Thanks, Bales, and good morning, good afternoon, everybody dialing in. As you said, so I'm in my 25th year at ClearBridge. I've been part of the strategy for over 20 years, so I can't say I'm necessarily someone who in the past was looking for change. But I am a believer that what we've done recently and what we're trying to do for the future is part of a natural evolution of the strategy. I mean, I think to ensure the next multiple decades of success, this has been from a team perspective really a huge success. I think it's something that in any walk of life you need to evolve in order to guarantee future success. So the team's been in place really since the end of March, since the beginning of April. But as many of you know, I've known Aram for over 15 years. We've worked very closely together at ClearBridge for over 15 years. So the integration of the day-to-day partnership with Aram has really been seamless. It's been well beyond my wildest dreams in terms of how excited I am for the future. I can also mention that Amanda Live has become a dedicated analyst for the franchise, for the strategy, and Amanda's worked at ClearBridge for almost a decade, so also might be a new name to some of you, but I think you're going to become much more familiar with Amanda as we move forward and as she becomes again a day-to-day member of the team as she's been, and she's been another phenomenal success from where I sit. Before I talk about some of the evolution or what's new, let me go back a bit and talk about what you shouldn't expect to change, and that's the overall philosophy of aggressive growth, multi-cap growth, the franchise that many of you have come to know over the last what'll be next month, 38 years, which was started by Richie back in the early 80s. October of 1983 was the inception of the Aggressive Growth Mutual Fund. And I think, from where I sit, you want to embrace what has been one of the most successful franchises, not only at ClearBridge, but in the industry over almost 4 decades, right? And so I think as we frame today's discussion and what's new, what's different, I also want to talk about embracing the legacy and remaining true to the philosophy that I've come to know since being part of it since the mid-90s. And I think you want to speak to the tenets of success that have worked, not just in today's market, but going back in many different types of market environments, and again, almost 4 decades of investing. And a lot of you know this, but I'm going to quickly review, how this strategy was built, what's made it so successful. The key, I think, to everything that we try to do in growth investing is being long-term investors, right? We're long-term business owners with a deep research bias, I would say, in businesses that have durable competitive advantages that are growing, that are expanding, that can continue to grow over long periods of time. And looking at some of the success stories that we own in the portfolio today, companies like United Health Group, which is an investment we've had since 1992, and it was a sub-billion-dollar company in terms of its revenue base, or Comcast, since the early 80s, mid-80s. I think what we try to do is look for companies that can translate or transform an innovative product or an innovative product or service into a great and sustaining business that ultimately translates into significant profits, free cash flow, and I think we've also always tried to be, very value conscious when we invest. I referenced a deep research bias. I think we do an enormous amount of work and spend a significant amount of time before we take or make an investment in a company, and we also want management teams running that business that are really investing alongside of us, that are also focused much more on the long-term health of the business and growing out the business, investing for the future, and continuing to evolve themselves over time. And so while many of the businesses transform, they continue to gain market share, continue to grow that competitive moat, and always look at where the business is going for the future. So again, you're left with a high conviction, 40 to 50 stock portfolio, depending on the vehicle, where we as the managers are deeply engaged with the business managers themselves, focused on what the value we believe of the business is worth over the long term, and we continue to look for businesses where earnings growth can compound over the long term. A lot of this should sound very familiar to what you've known and come to expect from us over the years. In terms of enhancements, in terms of the evolution of the strategy, I think what Aram and myself are really looking to do is employ a more dynamic and repeatable process in terms of how we add new ideas, how we exit or divest older ideas, as I mentioned, in terms of building out the portfolio construction, and we'll go into some more details on this. What that'll allow you as clients to do is have a more of an understanding of predictable outputs. What should the portfolio look like? How do you expect us to react when you get into more volatile periods in the market, like we've been going through for the last month or so? And we'll talk about some specifics in terms of changes that we've made to the portfolio. But at the end of the day, we want to continue to sharpen our sell discipline. I think be more active both on the sell side and the buy side, both exiting positions where the thesis is no longer what the initial reason for buying the stock looked like, or the business is overvalued or fully valued, and continuing to find more new disruptive companies for the future, along with building out the pipeline of prospective new ideas. And Amanda's been hugely helpful in helping as we build out our pipeline of next generation companies for the portfolio. So, I think that is really the key, is more process, more construction, being more active and more tactical, particularly in some of the more cyclical areas of the portfolio. And as we move through this webcast, we'll talk about some specifics on just since the spring, where we found some new ideas, 6 new ideas already in the fund. We've divested a number of positions as well. So we'll get into some more specifics as we move forward.
Great. Thanks, Evan. Aram, clearly you've had a long history with the firm also, and a very successful history on the small cap growth portfolio, your fund, ClearBridge Select Fund. But as we can see here on slide 3, as Evan mentioned, one of the first changes to the strategy since you joined in April is really this implementation of a framework around portfolio construction. Can you walk us through this new construct and how the team is really looking at growth in these specific areas?
Sure, happy to. So the management announcement was made in Q4, and that really gave Evan and I, a quarter and a half to formulate some of the changes and improvements we were making to the strategy. And one of the things that Evan and I were interested in doing was crystallizing a portfolio construction, to take a look at where the portfolio sits today and where we thought it should be positioned for the next 5 to 10 years ahead. And one of those areas was really crystallizing the portfolio construction. And looking at the current portfolio, we thought that there wasn't enough really rapid growing innovative companies. And we were a bit too heavy in some of these other areas that you see in our growth pyramid. And so you should think about the durable compounders as the foundation of our portfolio. These are companies growing kind of mid-single digits, well into the double digits. They are in somewhat mature industries, or their business models are more hardened. And so there's plenty of growth ahead for them to continue to grow in a growth market and consolidate market share. But they're also yielding the benefit of making those earlier investments and building out their sales force and R&D efforts and infrastructure. And so there's a fair amount of operating margin leverage that comes along with that growth. And we're going to complement those with companies that are earlier in their life cycle, and these are the disruptors in that sort of teal middle section. These are companies that are growing north of 20% a year, highly innovative, either creating a new market that didn't exist before, or they're going into an existing market and disrupting it through product and service innovation. And this was the area that was needing some new blood. And so Evan and I have been focused on that area as building out some additional exposure and adding some new names there. And then the remaining pieces of our portfolio construction are either in cyclical growth businesses or improving growth. And so cyclical growth businesses are businesses that are growing, but they're in more cyclical industries, whether that be semiconductors or autos. So we need to be focused as much on the long term as sort of where we are in the cycle for those products and managing our position size around where we are in the cycle for those businesses. And then the last piece of our portfolio construction is improving growth. And these are companies that are going through some sort of change within their business, and it's usually some sort of combination of management changes, business model changes, capital allocation changes. And so there's this series of changes that are taking place in their business, and we believe these are the right changes to be taking place. The company is going to emerge out of these changes in a stronger position, and the valuation is very attractive and rewarding for investors who can kind of use that long-term to their advantage by investing in a business today that's going to look quite different and be rewarded with a higher valuation in the future. So the proportions of the pyramid are aligned with how we see our portfolio position. So these durable compounders at the bottom are going to be around half of the portfolio. The rapid disruptors are going to be 25% of the portfolio, and then cyclical growers and improving growth make up the remainder. And so we believe that this is going to position us to outperform in a range of different growth markets and have nice balance across those. And so we think this is a good construct to use as we look at how the portfolio is positioned today. There's around 10% of the portfolio that we believe should be in these rapid disruptors that have been allocated to other areas within our portfolio construction. So a lot of our new idea generation, as well as the transactions and existing names in the portfolio, are focused on rebalancing back to where we think the portfolio is best positioned from a portfolio construction.
So Aram, in terms of being opportunistic, would you say the cyclical area of the portfolio has been an area that you and Evan have taken a lot of action currently?
Yeah, it's been an area that we have been taking action in to rotate some of that away from some of the companies that have seen cyclical benefits with inflation and commodity prices. And so we've been trimming and exiting those areas of the portfolio and rotating out into some of the more disruptive businesses, as well as you should think about us looking for other cyclical businesses that have more secular cyclical drivers and less exposure to things that they can't control, like interest rates or commodity prices.
Great. In terms of, well, I guess a couple of questions for you both here. As you look at the portfolio, Aram, where are the big ideas, in terms of areas of opportunity for the strategy to really capitalize on going forward? And secondly, Evan, maybe, clearly we get a lot of questions today about value versus growth. It's been a hot topic amongst investors. What are your thoughts on how you position for these ongoing kind of market rotations in the portfolio? And does it still influence stock picking for you both?
So to address the big ideas, our new idea pipeline is rather lengthy, and it focuses on where we have portfolio needs. So going back to that portfolio construction of being lighter on the rapid growing disruptors, as well as where we see the biggest opportunities over a multi-year time frame. And so that's focused us mostly on companies in the kind of sweet spot of $10 billion to $50 billion in market cap range. Those are the companies that are sustaining, on the most part, higher growth rates, so they have a long runway for growth that we can take advantage of as long-term investors. And they're also acquirable. These are businesses that would fit very nicely in a larger company that's looking to augment their innovation roadmap, as well as acquire scarce human capital in areas like data science and analytics, and enterprise software, and as well as in the healthcare space with emerging technologies. And so, the strategy has benefited over the decades of finding these companies earlier in their life cycle, and either they compound and grow at very, very high levels, or they end up getting acquired. So that's been a sweet spot for us to focus on. Those companies are also earlier in their public market cycle, and so we're interested in capturing those companies before they become big benchmark weights in the indices. In terms of areas, there's 3 areas that we've been targeting. We're looking beyond these, but these are 3 areas that we feel like we could use the added exposure in the portfolio to complement some of the existing industries that we have some heavy exposure in, as well as these are ripe areas for innovation and growth. And those 3 areas are enterprise software, e-commerce, and new consumer business models. And the last is within the healthcare space, areas within diagnostics services and med tech. So outside of sort of the therapeutics area that we've had a heavy overweight to, and still see opportunity there, but we think there's a lot of other opportunity in the companies that are providing the picks and shovels to a lot of that innovation that's taking place on the therapeutic side. That's where we're focusing on for finding those next big ideas in the portfolio.
Great, thanks. And Evan, maybe you could touch on that value versus growth question.
Yeah, sure, Bill. It's a question we get a lot, and I think just to look at the sort of characteristics of the portfolio, I think it's, this is clearly a strategy that's sort of a blend of growth and value, right? And in other words, we're growth managers, but we're looking at the market rather than growth versus value as value and overvalued, right? I mean, we're trying to buy companies that are growing double digits, and as we both discussed, trying to focus more on those kind of big growers, 20% plus, but we're also looking to make sure we pay a reasonable price for the business, that we're not paying a full or overvalued price. And along those lines, we're also looking for companies that can not only grow quickly, but remain very profitable throughout the growth cycle. So of the 6 names we've added, 5 are profitable today. The other in the diagnostics space is should be profitable within 5 years. So it's not buying concepts and it's not buying overvalued businesses, but it's really trying to buy businesses that can grow quickly and ultimately generate significant cash and free cash flow. The last few years, growth has really led value up until the sort of the post, I guess the last 2 years value, but that's been driven more by commodities and financials, and as we referenced earlier, I think some of those companies have become more fully valued over time. It's an area where we've certainly used the sizable rally in commodities and energy to divest some of those positions. And in the growth space, you look at the indices, and I referenced earlier, we're business owners, we're 95+% active share, as you see in the characteristics chart right here. And the reason being, the growth indices today, not wholly unlike 20 years ago, are really dominated by technology companies. Today, the biggest difference is they're mostly, if not all, mega cap names. You know, you look at the characteristics chart, the growth index weighted average cap is now $800 billion, which has moved up exponentially over the last few years. So to your question, I think there's a lot of companies within the growth space beneath the FANG and Microsoft big benchmark holdings where there is significant growth. It's still very attractive value levels with free cash flow yields that are starting to increase. And a number of the names that we've added, companies, for example, like Match Group, like HubSpot, which have been new additions within the portfolios, again, fit that type of business that Aram talked earlier about, in that $10 to $50 billion range. Match is about $40 billion, HubSpot's about $30 billion, but where there's still years of growth ahead, where they're past the startup phase, where they're now cash flowing at significant levels, but where the growth opportunities, both through their core market expansion as well as adjacent opportunities, remains massive. So we're continuing to look at those businesses in the growth space, I'll say down the, for the most part, down the market cap spectrum from the really big stuff that dominates the growth indices today. And I think there's still a tremendous amount of opportunity there. You know, Aram talked about M&A. It's been a big theme for the portfolio over 40 years, companies that we buy that get acquired. But I think even in the, even without any M&A benefit, I think we own some good growers. So to answer the original question, Bailey, I think, growth and value cycles will continue to run their course. We are looking more at intramarket and market volatility on a short-term basis to buy positions that we feel are well positioned to grow rapidly where valuations are still attractive. So, I do think that's where you've seen the activity is being more tactical on some of those value-oriented commodity names and adding to some of the growth names, especially after they have meaningful corrections the way we've seen recently.
Excellent. This may be a good topic for Aram to talk about, as he's, Aram, you've had a successful career identifying growth companies that have moved out of that kind of small and mid-cap space into larger capitalization size companies, almost like a DocuSign, which I'll highlight on the screen. Maybe you could talk a little bit about DocuSign and some of the advantages that you see there.
DocuSign is a company that we know quite well. We participated in some of our other strategies that do private investing in one of their later VC rounds back in, I think it was 2015. And so getting to know these companies earlier, even before they might be investable, is extremely helpful for us to build that relationship with the management team and understand the business model earlier in its life cycle, to be in a position to make that investment when it's deemed ready within the strategy. It's also very helpful in spending time with some of these early emerging companies, because it helps us be smarter in maintaining the existing names in the portfolio from a competitive perspective. So knowing these companies that are rising, that are raising a lot of venture capital with themselves potentially disruptive businesses or technologies will help us in again, like de-risking the names that we currently own in the portfolio. And so DocuSign is a good example of that. It was a company that, again, we invested in privately in 2015. They were a single product company earlier in their life cycle, burning cash at the time they went public. It was a business that we thought could healthfully sustain growth levels in sort of the high 20s to mid 30s for many years in a lowly penetrated market. I'm sure most of you guys are familiar with DocuSign, but DocuSign started as an e-signature technology, allowing people to verify agreements digitally. So instead of taking and printing out documents and putting them in a FedEx and sending them back and forth, and then things get lost in the mail or they sit on people's desks, this all did this digitally through a web-based application. But subsequently, and why it's very applicable to the aggressive growth, multi-cap growth strategy, is they've taken this core e-signature platform and created a lot of new services and capabilities around it. And we believe that these additional capabilities doubles the addressable market on a global basis. And we've also seen at the same time ramping profitability and cash flow in the business. It's now a quite profitable business. And I think it just shows you the power of returns and profitability in the core business that's allowing them to invest in these new vectors for growth. And that's something that we look for in most of our companies, is the fact that they have this core business where they are a dominant player, they're scalable returns in the business, and then they're using that abundant cash as sharp management teams to redeploy it back in growth and innovation to expand into adjacent markets and new products and services. So finding these companies earlier and paying attention to them, even if they're not ready for aggressive growth, multi-cap growth, but as a team to continuously be looking around corners to find these companies, both as they're rising and can be potentially bought in our strategy, and then also from a competitive perspective, making sure that we're constantly de-risking the ideas that we own in the strategy.
Terrific. We received a question from one of the callers, and the question pertains to if you look at turnover for the year, it's at roughly around 8.2%. And the question is, how much higher can we expect it to be or to increase for the rest of the year? I think it's a good point, but I also thought maybe we could elaborate a little bit on that topic and say, hey, you know, where do we expect some more of the changes that would contribute to some of that turnover going forward for the rest of the year? Is it adding to more of these new positions in the portfolio, or you know, more trimming on the cyclical side?
Yeah, I'll take that. Thanks, Bailey. Great question, and I think there's a few components to turnover you referenced there. So let me start with, you know, the initial one, which is just kind of some of the repositioning of the portfolio back to the construction discussion that Aram outlined really nicely earlier, just around making sure the portfolio is optimized from a growth perspective for different types of growth, where we want longer term the weightings to be with 50 in the compounders, 25 disruptors, adding to some of the names there, and then the 25% at the top. So that's you know, we're still in the process of repositioning you know, into some of those faster, rapidly growing disruptors, and so expect a little bit more there on the turnover side. I think in terms of exiting or divesting some of the cyclicals, we're largely complete there. We sold you know, kind of a couple of months ago, and there was a lot of excitement around stimulus and infrastructure, and you had kind of blow-off moves on the upside in some of those businesses, like the pure commodities, where the stocks became more fully valued. So in the next year or 2 years, as we finish kind of repositioning the portfolio for where we want it to be optimized, I'd expect turnover to be slightly elevated versus what many of you have come to know, but still incredibly low versus a lot of our peers. So 15 to 20% is the type of number of turnover that in a normalized basis I'd expect the portfolio to look for the next couple of years. And then longer term, you know, many of you have come to know a very low single-digit turnover portfolio, and certainly I think what that speaks to is time horizons. One of the first comments I made is is embracing this idea of long-term disruptive investing, owning companies for decades and benefiting from the compounding over long periods of time. When we're looking for a new investment, we're not looking, at a short-term price target. We're looking at how can this business sustain and grow its competitive advantage. So you should still expect kind of a mid to high single digits longer-term turnover number, which speaks to, again, the idea that we have very, very long-term holding periods, at least initially, when we buy something. Of course, things change, market volatility, thesis creep or thesis change will dictate, again, more of a sell discipline going forward. But think kind of low teens to mid to high single digits long-term turnover. In terms of where, you might want to pull up the sector weightings, but you know the strategy. You know that for many years, Richie and I have had exposure to healthcare, really going back to the 80s, and then the first stock ever bought was Genentech in 1983. And communications, primarily media, programmers, broadband, has also been a healthy weighting in the portfolio. Technology, we talked about expanding some of the subsectors and industries within technology, but as you can see from the chart, there's not a lot in some other areas of the market. Right? Consumers is zero. Other areas like financials or fintech payments, et cetera, have historically been very low. And so what we've really tried to expand upon, and again, it's Aram, myself, and Amanda looking at companies that are true growers that fit our definition of long-tailed growth with adjacencies and tailwinds that might fall either outside of some of these areas or, again, looking at different subsectors or industries, and healthcare is a great example of that, where we've owned therapeutics, again, for the life of the strategy, but we haven't had as much exposure to companies like Guardant Health in the liquid biopsy diagnostic space and other areas that are more involved in labs and tools and diagnostics, which I think longer term, analytics as well, big crossover between technology and analytics, where you have real breakthroughs occurring in big addressable markets, multi-billion-dollar addressable markets with true innovation occurring. And these are the types of businesses that are actually, in many cases, bringing down the cost of the healthcare system, finding the new discoveries like we've seen recently with the vaccine development, how quickly it occurred for a disease like COVID that we didn't know existed just a couple of years ago. So this is, these are some of the areas that we've been focused on. So remaining true to some of the core sectors, expanding beyond those, digging deeper into some of the subsectors. And then the final part of your question, Bailey, if I remember, it was also just position sizing. Historically, we've had a relatively long tail of incubators and then a very chunky top of the portfolio. And I think that the theme going forward will be fewer 10% type weightings within the portfolio, but still remaining high conviction managers. So more 4, 5, and 6% weightings. And at the tail of the portfolio, if we believe a company has, maybe a higher risk, higher reward opportunity set, still capturing 40 to 50 basis points up to 1% at the tail versus, some of the really tiny positions that we had in the past. So number of names doesn't change, but fewer, 1 and 2 basis point position, of which we have none today, more kind of 50 basis point to 2% weightings, and more 4 to 6% weightings at the top of the portfolio. So still, about 50% in the top 10, just more balanced, and still a relatively, longer tail, but again, of those kind of next generation incubators. And we want to make sure they have an impact on the performance and the portfolio results.
So maintaining that concentrated nature that the strategy has historically been known is clearly going to stay put, and having a higher active share also as it relates to the index will remain in place. Does that make the performance of the strategy, you feel, going forward, does that make it especially when you're going against mega cap tech and things like that, and the benchmark? Is it do you think we should expect more, in terms of volatility, in terms of performance going forward, or the changes that you both are implementing should hopefully smooth out performance a little bit?
It's not really smoothing out. I still think, this is very different looking from a more traditional style box, pure, mega cap tech heavy strategy, right? The performance correlation to the index should still remain very low. This is a non-correlated strategy to many of the more, ETF-looking large growth type strategies. It's going to have, and we've seen this recently, it's had very different looking day-to-day swings versus the index. As you said, Microsoft, you look at the returns of the big names, the Microsofts and Apples of the world, which make up, a third of the index just in 5 names today. Those names have continued to outperform, even where we're adding, in the technology space. Again, it's those 30, 40, $50 billion companies plus or minus, and it's also looking to benefit from some of the trends at a company like Microsoft, whether it's info security or it's the growth of the cloud at Amazon and Microsoft, but doing it in a different way with companies that are earlier in their life cycle, that are in many cases partnered with the big guys, and they're more disruptive and certainly have years of growth ahead. So, from where I sit, I think I still look at this is Evan speaking, I still look at this really as an anti-ETF kind of product with very non-correlated returns. And then you throw in the M&A caveat where you have companies that over time should be attractive, to Aram's point, to some of the big guys as well, the way that Nuance was to Microsoft, this year. And those are the types of returns you should expect. Very similar to what you've come to know from the last nearly 40 years of the strategy.
Absolutely. And Aram, maybe one of the, in terms of media darlings or media sensation, however you want to put it, crypto is a topic that continuously comes up, and I guess we could broaden it out into other areas that have become, big areas from a media sensation standpoint, whether it's self-driving vehicles, cannabis at one point, electric vehicles. What are your thoughts around some of these other kind of areas that have become very, very hot in the market?
So the team pays attention to those trends. We always want to be understanding what technologies and services are emerging. Again, looking around corners to understand how the world is evolving, to try and find those business opportunities. We have found with a lot of those, though, they're just too nascent, that it's unclear who the winner is going to be, what the return dynamics are going to be. There's a tremendous amount of capital that needs to be deployed to try and build these products and services, get them to market, commercialize them, and usually there's a lot of competition. And so we tend to sit back on those and wait to see a narrowing of the playing field to make sure that there is more of a durable business and really de-risk what the trajectory of growth is going to look like and what the inevitable returns are going to be, and make sure that they're not competed away. So we're less likely to participate in those very early on. But what we do, instead of participating in the actual wide playing field of participants, we'll look for the companies that are providing services and products or distribution to those companies. So the ones that will benefit from all the innovation, but do it in a manner where, because they are specialists in what they provide, and where they sit within the supply chain, that they are more profitable, their position is solidified, and so it's a much more de-risked way of playing that innovation in some of these markets versus actually trying to pick, the one winner in a pretty wide playing field who's spending a lot of capital in an unproven business model.
Terrific. Thank you. Well, guys, I know we're bumping up on the 40-minute mark here. I want to thank you both for taking the time to talk to all of our investors. And audience, please accept all of our thanks for all of your support with the ClearBridge Multi-Cap Growth Portfolio, ClearBridge Aggressive Growth Fund. We do thank you all for all the support that you've provided us with these two long-running strategies at ClearBridge. So on behalf of Evan and Aram, thank you very much for joining us today on this call. Enjoy the rest of your September, and we look forward to talking to you in the near future. Thanks again.